Let's quickly pull up something like a Tata Motors passenger vehicle business. And we have been talking about it that post the quarterly earnings, there has been a weakness in the share price performance. Let's go deep into why is that. The three key takeaways has to be that the results were weaker than what brokerages and analysts were expecting. Cyber attacks as well as the US tariff impact has had an impact on the overall business of the company. And finally, in terms of JLR business, they've also seen a guidance cut for FY26. So largely revenue was down 13.5% in this particular quarter. EBITDA actually reported a loss of almost 1,000 crores in this particular quarter. And while the net profit, you will see a subsequent very high jump because at 76,000 crores, that's largely because of a notional gain on the commercial vehicle business that was demerged. So there is the net profit on the notional gain. When you look at the JLR FY26 guidance, we know these numbers that the guidance has now been cut to 0 to 2% for the EBIT margins versus 5 to 7% earlier. And free cash flow is also expected to be negative at minus 2.2 billion pounds versus almost near zero in this year. Now, brokerages like Jefferies have maintained an underperform rating on the stock. Let's pull up Jefferies very quickly first. It's a target price of 300 rupees per share that they've given and highlighted that the cyber attack related disruptions have continued in this particular quarter and highlighted that they see multiple headwinds for the JLR business going forward with the increased competition as well as the consumption tax going up in China. JP Morgan, on the other hand, has highlighted that 385 rupees per share is their target price. Guidance cut seems realistic for now is what they highlighted and mentioned that the margin delivery, while in the India business has been strong, the extent of margin erosion in the Jaguar Land Rover business is a key negative. But the group CFO, Mr. PB Balaji, also said that the company is expecting a better H2 performance compared to H1, obviously. Let's listen into what he had to say.
We have given you the guidance there, where we believe now with production fully stabilizing in November, the whole of month of October has been impacted. To that extent, there will be an impact in Q3. But here onwards, we should expect to see things picking up. So we expect H2, therefore, to be better than H1 as far as JLR is concerned.
Well, Mr. Balaji was, of course, responding to a question in the media call from me and largely highlighting that there could be some multiple key factors positive going forward. But Mr. Chokalingam, we have spoken to you in the past about the auto space. You highlighted you like something like a Mahindra and Mahindra. But how do you view the results of Tata Motors, the PV division? And if someone's already holding the stock, would you recommend them to get out of it right now and buy something else in the passenger vehicle space, if any?
I would suggest, two options, either considering M&M or Bajaj Auto within automobile, or moving towards Tata CV company, commercial vehicle company. Because, the Tata Motor passenger vehicle is not able to outperform the domestic competitors in India. And secondly, JLR business is always, giving you a lot of uncertainty. And third, it's a subsidiary technology company also depends upon the global growth story. So Tata Motor PV is largely on a global growth story, two-thirds of the business on global markets, whereas the CV business largely domestic. Even it's an investment in Tata Capital, it's a play on domestic. So I believe medium to long term, the domestic story would more stable and steady, growth scenario is possible. So therefore, I would prefer Tata Motor CV to Tata Motor passenger vehicles.